Hey, welcome back to The Dive. Our guest today has more than 40 years of experience in advising high net worth clients in the investment industry, and he's an expert on the economy. He will deep dive into the expectations of the upcoming FOMC meeting, inflation, equities markets, oil, food-related commodities, nickel, gold, and he'll touch on the U.S. housing market. He is the founder of Oxbow Advisors. Ted Oakley is joining us today. But before we bring you Ted's interview, do me one quick favor and go ahead and smash that subscribe button, please. Hey, Ted, welcome back to The Dive.
Thank you, Cassandra.
Yeah, thank you so much for joining us today. Okay, so most investors are expecting rate hikes beginning this month. We have to ask, what are you expecting from the upcoming FOMC meeting? And how do you think the market will react to it, given the current inflationary environment and Russia-Ukraine crisis?
You know, Cassandra, I think they have to do the quarter in March to save face. I mean, I don't think there's any way now, especially the CPI coming out this week and what's happened in the last 2 months. It'd be very hard for them. It might be actually impossible, I think, not to raise it a quarter. They obviously have their eyes on what's going on overseas and all this other stuff. But we've said all along, we would be surprised if they ever got past 2 raises this year. And the reason being is because you're starting to slow the economy already. We've seen signs of that in late January, February, early March. And I think when you get into $5 gasoline and all the prices of food, et cetera, for the average person now, that's going to really slow what happens.
Mm-hmm. Now, the equities markets have been red for several days now, while commodities have seen a surge in prices across the board. What are your thoughts on the recent volatility being seen in the global markets?
Well, I have to tell you, we've owned oil for some time, well before it was popular, and gold as well, and the miners and fertilizer, everything that's inflationary. And we've had it really for the last year and a half or so, more maybe 18 months, and so that's not something we didn't expect. I have to say we didn't expect this extreme of all of this. I don't think we would have gotten that either if that happened. But I think for the average investor, they've all been locked up over here in index funds and exchange traded funds, all the wrong things. Because if you look at everything they own right now, it's probably not doing too well. And very few of them, I think, have any of these other things that fit in together with it. But, probably somewhere that shifts and, you peak these things out somewhat. Obviously, slower demand will peak it out, finish it. But I think that in addition to that, what happens is you do a flip. As you get in the latter part of the year, the rates come down and in the commodities, they slow down and inflation slows down. So that's the way we see it right now.
Mm-hmm. Okay, so let's talk a little bit more about oil here. Last week, oil major Shell was heavily criticized after they purchased crude from Russia at a record discount, only to apologize for it and cancel all Russian operations following blowback from the public. How significant is Russian oil to global markets? And do you believe this will result in a long-term shift away from Russian-sourced energy?
Well, I'll just give you some examples. If you go back to Iraq and Iran and it had oil, when we were doing embargoes, and look at the last 25 years or so, and we would have things, we would put the heat on them. And what they would do, they would find avenues to sell oil in different places. It's not anything, if they sell it to one country and that country sells it to us, it doesn't look like we're buying it. I don't think that's going to happen right now. I think there's a concerted effort to really pressure Russia all around by everyone. But in time, that's what happens because they end up moving the things around. They had a recession going into this thing. So that'll have an impact on them. It's unfortunate for us, in our opinion, that, they didn't keep the Keystone Pipeline or we wouldn't probably have this problem. But when they break it after today, that's 800,000 barrels a day. It's a lot.
Mm-hmm. Now, Russia has threatened to close a major gas pipeline to Germany and warned $300 oil is possible if the West bans its energy exports. What are your expectations in terms of energy pricing? Should energy exports from Russia come to a halt?
Well, if they do that, and they have more than one, it's interesting because I don't think people know this, but they have more than one gas pipeline. And the one they talk about, Nord Stream, all the time is one. There's another to the north that comes around. I think some of that is not as strong as it looks like it is. But for Europe right now, I mean, they are going to be in a world of hurt in terms of economically, because everything they touch now is really expensive, oil and natural gas. So it will have an impact.
So outside of oil, Russia is a key producer and exporter of both metals and grains. Recently, wheat prices jumped to a 14-year high, with some indicating we may encounter a food crisis similar to 2008. What are your expectations in terms of follow-on impacts of the rising prices, such as with such food-related commodities?
Well, Cassandra, what happens is if you look today, for example, just this morning, if you look at soybeans, corn, wheat, all very high compared to where they've been the last 3 years. And it's not just wheat, it's numerous things. And if you look at those and then the metals, that's going to have an impact. But more than that, if you look underneath all of that, what agriculture really uses, which is seed, fertilize, that type of thing, those things are just going through the roof. And all of that feeds into it. And, our take on it, though, is that if you look at the average person, okay, who's spending money on food, gasoline, and rent, they're going to really get hurt the next 6 months because they can't afford that. And I think that's where it works itself in. I feel for everybody, particularly on the food side, because I do think it's really going to get expensive here.
The London Metal Exchange suspended the trading of nickel after prices more than doubled to surpass $100,000 per metric ton, with the exchange now indicating it's going to reverse some trades. Do you think this decision to cancel trades impacts the faith in spot markets? And what is your long-term outlook for nickel following these events?
Well, Cassandra, I will tell you, when I don't trade something and I don't own it, for me to give you an opinion on it was just that. Really, yours is probably better than mine. And the reason is we don't trade nickel. Now we trade gold a lot and the miners a lot. But I think what happened in nickel, and I've seen this before, the commodity markets, you get, first of all, they're highly, highly leveraged. So if you get a short squeeze going, you can really press these prices in a hurry. And it's similar to back, you probably don't remember this, back in the Hunt silver debacle, when they had the market corner, and then all of a sudden it went way up, then it just crashed. It messed everything up. And what happens is you get into these things from time to time. I don't trade nickel, but I can see what happened in the trading of that. Now, if you start canceling trades, that's a problem, in my opinion, because then people are not going to have as much faith in the futures. And if I'm going to hedge a trade, and then I think they're going to take me out, I don't know. I wouldn't like that myself.
No, definitely not. Okay, so let's move on to gold then. Gold has again climbed above $2,000 per ounce, the first time since August 2020. How do you see the gold price action recently, and how sustainable is this?
Well, here's what happens typically with gold. If you'll find out, Cassandra, it correlates with the bond market. Now, we have two contra views from a lot of people, but we think that the 20 and 30-year treasuries are going to go down in yield, up in price. And if you see it already, if you look at the 2-year and the 10-year today treasury, there's barely a quarter point difference between the two. In other words, we're already flat. We're within a half a point of being inverted, which is always a harbinger of a recession. So if you take gold and you tie it to, which we do, we tie it to the bonds. I think gold probably got ahead of itself today. It's up at $70 or $75 at the high. It's probably 40 right now. I could see it drift back in $100 or 120, but in the long run, I'm talking about over the next 18 months or so, gold should follow the bonds and it should follow what's going on in the world. I'm talking as far as people being concerned. and you get those two things moving. And I could see gold then breaking out of that old high, which was close to 2,100, and maybe go on up to 2,400, maybe higher.
Okay, so lastly, Ted, we know that Oxbow recently bought a position in Getty Realty. Some say that the U.S. housing market is in a bubble that's about to burst. Do you agree with this sentiment? How do you assess the current environment?
Well, Cassandra, let me address Getty first. It's really we bought it too early. It's probably down about 6 or 7% from where we bought it, and it's we own in one strategy particularly. We own real estate investment trusts, and Getty owns a lot of convenience stores and a lot of quick lube stores, that kind of thing, which is okay. People use that during a recession. It's okay. The problem is that we probably could have bought it a little cheaper than where it is right now, and not that we wouldn't add to it if we got there. How that ties into the housing market is not totally correlated, but I will say about the housing market, I think we've already peaked the housing market last month. I mean, if you look at today, even today, after where rates are, you're about a 4.1 or 4.15% on a 30-year mortgage. And if you take a mortgage payment in the last 12 months, it's gone up 20% in the last 14 months. And the price has gone up 18 to 20%. So what's happening is they're pricing themselves out of the market. So if you take that, okay, and then you overlay that with what I talked about gasoline and food and everything else that fits into that, then we just think the housing market has to slow down some.
Well, thank you so much for joining us again today, Ted. It's always so nice to talk to you.
You bet, Cassandra. Thank you.
Thanks so much for tuning in today. We'll be back again tomorrow with the latest news and updates, so be sure to follow along by subscribing below and hitting that notification bell.